Imagine you take $1,000,000 and move to Africa. Not to vacation, not to visit, to live, to build, to operate, to try to convert that $1,000,000 into the kind of wealth and lifestyle that $1,000,000 produces in the United States. Most people assume this would be easy. $1,000,000 is $1,000,000. The number is the number. If anything, the thinking goes, $1,000,000 should go further in a developing economy. Lower costs, cheaper labor, less competition. The arbitrage should work in your favor. It does not work that way. And the reason it does not work that way reveals something fundamental about what wealth actually is. Something that the number in your bank account does not capture and that most financial education never addresses. Wealth is not a number. Wealth is a relationship between a number and the system that number operates inside of. And when you move the number from one system to another, the number does not behave the same way. It cannot, because the system is doing most of the work that you thought the number was doing. This is that story.
What $1,000,000 actually is in America. Before you can understand what happens when you take American wealth to Africa, you have to understand what American wealth actually consists of beyond the number. When you have $1,000,000 in the United States, you are not just holding a number. You are holding access to an entire ecosystem of infrastructure that your wealth moves through and that multiplies its effect at every point of contact. You have access to a banking system that is stable, insured, and connected to global financial networks. Your $1,000,000 can be deployed into a brokerage account in minutes, earning returns in markets that are liquid, regulated, and transparent. The infrastructure of wealth management, financial advisors, tax attorneys, estate planners, investment vehicles is built specifically to help you preserve and grow what you have. You have access to a legal system that enforces contracts. If you invest your $1,000,000 into a business and a partner defrauds you, you have legal recourse. Not perfect recourse, not guaranteed recourse, but a functioning court system with established precedent and enforcement mechanisms that make contract violation expensive and risky for the violating party. You have access to physical infrastructure that your wealth depends on. Roads that work, power that is reliable, logistics networks that can move goods efficiently, internet connectivity that allows you to operate a business without being physically present at every transaction. You have access to a dollar that is the global reserve currency, accepted everywhere, stable relative to most alternatives, and backed by the largest economy on Earth. None of these things are the $1,000,000. All of them are what makes the $1,000,000 worth $1,000,000.
The infrastructure gap. The first thing that happens when you move your $1,000,000 to many African countries is that the infrastructure your wealth depends on becomes unreliable or absent. Power. In the United States, you do not think about power. It is there, it is consistent, it costs money, but it works. In large parts of sub-Saharan Africa, power is intermittent, unreliable, and expensive relative to what it delivers. Running a business that depends on consistent electricity requires a generator, which requires fuel, which requires logistics, which adds cost and complexity to every operation before you have made a single product or served a single customer. This is not a minor inconvenience. This is a fundamental operating cost that does not exist in the environment where your wealth was built, and that erodes margin at every level of any business you try to run. Roads and logistics. The supply chains that American businesses depend on work because the physical infrastructure that moves goods is maintained and reliable. In many African markets, getting a product from a manufacturer to a customer involves navigating infrastructure gaps, roads that become impassable in rainy seasons, ports with bureaucratic delays, last-mile delivery problems that add cost and time that no amount of capital can fully eliminate. Internet connectivity. The digital business models that have made more millionaires in the last decade than any other category depend on reliable, high-speed internet. In many African urban centers, this exists. In the markets where the most underserved populations live, which is often where the most opportunity appears to exist, it does not exist reliably enough to build a digital business on. Each of these gaps individually is manageable.
Together, they represent a structural operating environment that your American wealth was not built for, and that it will absorb costs from continuously until it either adapts or retreats.
The currency problem. Your $1 million is denominated in US dollars. The moment you begin operating in an African economy, you encounter the currency problem. Most African currencies are not stable relative to the dollar. They depreciate. Some depreciate slowly, some depreciate catastrophically. Nigeria's naira has lost significant value against the dollar over the past decade. Zimbabwe's currency collapsed so completely that the country abandoned it entirely and operated in US dollars for years before reintroducing a local currency. Ghana's cedi, Kenya's shilling, South Africa's rand, all subject to volatility that creates a layer of financial risk that does not exist when you are operating entirely within the dollar system. What this means practically is that if you convert your $1 million into local currency to operate a local business, the real value of your operating capital is eroding continuously as the local currency depreciates against the dollar. Your revenue is denominated in a currency that is worth less every year relative to the currency your wealth was measured in. Your costs may be rising in local currency terms due to inflation, even as your dollar-denominated wealth measures those costs as stable or declining. The currency risk is not theoretical. It is the difference between a business that appears profitable in local currency terms and a business that is actually destroying dollar-denominated wealth with every transaction. Managing this risk requires financial sophistication, hedging strategies, dual currency accounting, strategic repatriation of profits that most American entrepreneurs who made their money in the domestic dollar economy have never needed to develop because the problem did not exist in the environment where they built their wealth. The legal and regulatory environment. In the United States, you can start a business in a day, register an LLC online, open a business bank account, accept payments, hire employees. The entire legal infrastructure of business formation is accessible, affordable, and fast. In many African countries, the regulatory environment for business formation is a different experience entirely. Not because the laws are necessarily hostile to business, because the implementation of the laws is inconsistent, slow, and frequently subject to informal costs that are not on any official fee schedule. Licensing requirements that take weeks or months to process. Tax regulations that are complex and inconsistently enforced in ways that create uncertainty about actual compliance. Labor laws that are difficult to navigate without local legal expertise. Land ownership rules that are complicated by customary land rights that exist outside the formal legal system, and that can make property rights ambiguous even when documentation appears clean. And corruption. Not universally, not in every country, not in every interaction, but as a structural feature of the operating environment in enough markets and enough sectors that any honest assessment of doing business in many African countries has to include it as a variable. The American businessman who made their $1 million in a system where the rules were written down, consistently enforced, and accessible without informal payment is not equipped by experience or expectation for an environment where the rules are written down, but the actual operating conditions require a different fluency. That fluency takes years to develop, and while you are developing it, your capital is absorbing the cost of your inexperience.
The network problem. In America, your wealth came with a network. Maybe you built the network before the wealth. Maybe the wealth helped build the network. But the two are intertwined in ways you probably do not fully recognize because you have always operated inside the system that produced both. You know who to call when you need a contractor. You know which banks will lend to your kind of business. You know which lawyers understand your industry. You know which suppliers will give you credit terms because they know your reputation. You know which government office handles which permits, and who in that office can accelerate a legitimate process. This network is not money, but it functions like money. It reduces costs, accelerates timelines, and opens doors that capital alone cannot open. It is the accumulated social infrastructure of operating in a specific place for a specific amount of time with a specific track record. When you move to a new country, You leave that network behind entirely. You arrive with capital and no context. You do not know who to call. You do not know which supplier is reliable and which one will take your deposit and disappear. You do not know which lawyer actually practices the law as written and which one is managing your expectations about what the law does in practice. You do not know which neighborhoods are developing and which ones appear to be developing but have structural barriers that make them traps. This ignorance is expensive, not because you were unintelligent, because local knowledge is earned through time and experience and is not purchasable at any price. Every entrepreneur who has built wealth in America and tried to replicate it in a new market, domestic or international, has paid the tuition of this ignorance. The question is not whether you will pay it. The question is whether what you learn from paying it is worth what it costs.
What actually works? Here is where the story shifts. Because the argument is not that Africa is uninvestable. The argument is that the framework most Americans bring to the continent does not work, and that the framework that does work looks completely different from what built their wealth at home. The people who have built significant wealth operating across African markets share a specific set of characteristics that are worth understanding. They partnered with local operators who had the network, the regulatory knowledge, and the cultural fluency that no amount of American capital can substitute for. The capital provided scale. The local partnership provided the operational foundation that made the capital deployable. They identified sectors where the infrastructure gaps represented opportunity rather than obstacle. Mobile money is the most famous example. In markets where traditional banking infrastructure was absent or inaccessible to most of the population, mobile payment systems built on basic phone networks filled the gap and created enormous wealth for the people who saw the gap clearly before most others did. M-Pesa in Kenya, MTN Mobile Money across West Africa. These are not Western financial products adapted for African markets. They are products built for the specific conditions of African markets by people who understood those conditions from the inside. They operated in sectors where African markets are not underdeveloped, but differently developed. Agriculture, telecommunications, consumer goods, financial services for the unbanked, and where the Western assumption that sophisticated always means better was not correct. They took a long view. The companies that have built significant and durable value across African markets are not the ones that arrived with a specific product and a timeline. They are the ones that arrived with a commitment to learning the market, building relationships over years, and adapting their model continuously based on what the market actually required, rather than what their home market experience suggested it should require.
The deeper lesson. The American who takes their $1 million to Africa and finds that it does not behave like $1 million has learned something that most financial education never teaches. Wealth is context dependent. The $1 million did not change. What changed is the system it is operating inside of. The banking infrastructure, the legal infrastructure, the currency stability, the physical infrastructure, the network of relationships, the regulatory environment, the cultural knowledge required to navigate all of the above. All of those things were invisible in America because they worked. Infrastructure is invisible when it functions. You only see it when it stops functioning or when you move to an environment where it does not exist. This is the invisible foundation of American wealth that most Americans have never had to think about because they have never operated without it. Understanding this has implications beyond Africa. It means that wealth built in any specific system is partially a product of that system. That the skills, networks, knowledge, and advantages that produce the wealth in one environment do not transfer automatically to a different one. That the person who is wealthy is not separable from the environment that made the wealth possible. This is not a pessimistic conclusion. It is a clarifying one. It means that if you want to build wealth in any environment, including the one you already live in, the most important thing to understand is the system, not just the number. The infrastructure your capital will move through, the legal environment that will protect or expose it, the network that will accelerate or limit it, the currency and macroeconomic environment that will preserve or erode it. The $1 million is the beginning of the analysis, not the end of it.
What this means for you. You probably do not have $1 million to move to Africa.
But the lesson applies to whatever you have and wherever you are. The person who builds wealth in their specific environment, who understands the system they are operating inside of, who builds the network that multiplies their capital, who develops the knowledge that makes their decisions better than average, that person builds something that compounds. The person who has a number and no understanding of the system that produced it is one environment change away from discovering that the number was doing less work than they thought. Understanding wealth as a relationship between capital and system is not just an intellectual exercise. It is the framework that separates the people who build something permanent from the people who build something that only works under the specific conditions it was built in. Africa is not a problem to be solved with American capital. It is a different system with different rules that produces different results and that rewards a completely different kind of understanding. The American who arrives with humility, local partnership, long time horizon, and genuine commitment to learning the system can build something real. The American who arrives with a number and the assumption that the number is enough will learn at significant cost that it is not. The system is the wealth. The number is just how we keep score.